Ever tried to sell something valuable but no one wanted to buy? That's a liquidity problem. In crypto, liquidity is everything. It's what lets you buy or sell assets quickly at a fair price. Without liquidity, markets stall and traders get stuck. Think of it as the oil that keeps the financial machine running. When liquidity is high, trades are fast, and prices are stable. When it's low, trades are slow, costly, and risky. Before buying any crypto, always ask how liquid is it. Liquidity is your bridge between digital assets and real-world cash. In this guide, we'll show you why liquidity matters and how to use it to make smarter crypto decisions. You deal with liquidity every day, often without even realizing the concept is at play. It's a fundamental aspect of how markets function and how easily you can convert assets into cash, even if you don't realize it. Liquidity might sound like a complex financial term, but it's actually quite intuitive once you grasp the basic idea. Imagine selling apples at a busy market, a vibrant hub of activity where vendors and customers converge. Buyers are everywhere, eager to purchase your fresh produce, and you can generally get your desired price without much hassle. That's high liquidity. The market is fluid, transactions are smooth, and you can easily convert your apples into cash. Now try selling those same apples in an empty park, far from the bustling marketplace, and you'll struggle to find buyers or have to drastically drop your price to entice someone to make a purchase. That's low liquidity. The market is stagnant, and converting your apples into cash becomes a challenge. Currency exchange works the same way. The ease with which you can exchange one currency for another depends on its liquidity. Swapping dollars for euros at an airport, a common and frequently traded pair, is easy, quick, and cheap. That's a liquid market in action. But try exchanging a rare currency, perhaps from a small island nation, in a small town with limited international connections, and it's likely to be slow, expensive, and potentially even impossible. That's an illiquid market. In crypto, established cryptocurrencies like Bitcoin and Ethereum are like dollars and euros in the traditional currency world. They're traded on numerous exchanges around the globe, making them relatively easy to buy or sell at any given time. On the other hand, new or obscure coins, often referred to as altcoins, are like those rare currencies we discussed earlier. They may have few buyers, few sellers, and be subject to big price swings due to their limited liquidity. High liquidity in crypto translates to quick and efficient trade executions at prices close to what you expect. Low liquidity, conversely, can lead to delays in trade execution, higher transaction costs due to slippage, and increased risk of significant price fluctuations. Therefore, understanding this difference between high and low liquidity is absolutely key to navigating the world of crypto safely and making informed investment decisions. Liquidity is a crucial concept to understand in any market, especially in the fast-paced world of cryptocurrencies. High liquidity is like a deep, wide river. It represents the ease with which an asset can be bought or sold without significantly impacting its price. When liquidity is high, big trades flow easily and prices tend to stay stable. Think of it as a large, calm river that can easily accommodate boats of all sizes without causing ripples. In the crypto market, high liquidity means there are lots of buy orders, eagerly waiting to be filled. This creates a strong demand for the asset. And equally important, there are plenty of sell orders available at all times, ensuring a ready supply. This balance between buyers and sellers is what keeps the market healthy and liquid. Bitcoin is the classic example of a highly liquid cryptocurrency. It's the most traded digital asset in the world. Because of its massive trading volume, you can buy or sell huge amounts of Bitcoin at any time, and crucially, you can do so without moving the price much. This makes Bitcoin a reliable store of value and a popular choice for institutional investors. On the other hand, low liquidity is like a shallow creek. It represents a market where it's difficult to buy or sell an asset without significantly affecting its price. In a low liquidity market, even one big trade can cause chaos, leading to wild price swings and unpredictable market behavior. This happens because there are few buyers and sellers actively participating in the market. As a result, prices jump around erratically, and the bid-ask spreads. The difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept are wide. So if you try to sell a large amount of an illiquid coin, you might face some serious challenges. In such a scenario, you might have to accept a much lower price than you initially anticipated just to get your order filled. This sudden and unfavorable price drop is called slippage, and it's a common pitfall in illiquid markets. Slippage can be a costly problem, especially for large trades, and it can quickly erode your profits. Therefore, it's crucial to always check how many people are actively trading an asset and what the trading volume looks like. Do your research and assess the liquidity situation before you jump in and commit your capital. In essence, liquidity acts as a shield, protecting you from nasty surprises and unexpected losses in the volatile world of cryptocurrency trading. High liquidity brings big benefits. Prices are stable, so you know what you're getting. Trades happen fast. You can act on opportunities instantly. Tight bid-ask spreads mean you lose less money on each trade. In liquid markets, you avoid hidden fees and costly slippage. Low liquidity, on the other hand, means big risks, price swings, slow trades, and easy manipulation by big players. One large trader can move the price dramatically in an illiquid market. For safety and efficiency, always favor assets with high liquidity. It's the foundation of a fair and reliable crypto market. For traders navigating the volatile seas of cryptocurrency, liquidity isn't just a metric, it's a survival tool, a lifeline that can mean the difference between smooth sailing and a shipwreck. Understanding and respecting liquidity is paramount to protecting your capital and executing successful trades. Pros meticulously watch order books, those digital ledgers displaying the buy and sell orders for a particular asset. They do this to spot healthy liquid markets where there are plenty of buyers and sellers ready to transact. This ensures that orders can be filled quickly and at the expected price. These are the markets where big trades won't move prices significantly. A large buy or sell order won't cause a sudden spike or crash, maintaining stability and predictability. Thin order books, characterized by a lack of depth and wide spreads between buy and sell orders, are a warning sign, a red flag indicating potential danger. In such illiquid environments, big trades can cause big losses, as even relatively small orders can trigger significant price swings. Even long-term investors who aren't as concerned with short-term price fluctuations need to check liquidity before buying. It's a crucial part of due diligence. If a coin only trades on one small exchange with limited trading activity, you risk being unable to sell when you need to, potentially trapping your capital in a position you can't exit. Low liquidity can also break advanced tools like stop-loss orders, causing them to execute at far worse prices than intended, leading to bigger losses due to slippage. Using leverage, which amplifies both gains and losses in illiquid markets, is especially dangerous, as even small price movements can trigger margin calls and liquidations. Always check trading volume, a key indicator of liquidity and market interest. And carefully consider exchange listings before investing, favoring coins that are available on multiple reputable platforms. High volume and listings on major exchanges, the more the better, mean better liquidity, reduced risk, and a more stable trading environment. Ignoring liquidity is like sailing into a storm without checking the weather. You might get lucky, but the odds are stacked against you. Liquidity isn't just technical jargon, it's a simple, powerful concept. It's about how easily you can turn assets into cash without losing value. High liquidity means smooth, fast, and fair trades. Low liquidity means risk, slippage, and the chance of getting stuck. Before buying any crypto, check its trading volume and which exchanges list it. A liquid asset is like a building with many exits, safe and flexible. An illiquid asset is like a building with one narrow door, dangerous in a rush. Prioritize liquidity to protect your investments. It's your best tool for navigating crypto markets wisely. Make liquidity your first checkpoint for every crypto decision.